Good morning, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We are here. We are pleased to welcome today Eric Bossé, Senior Vice President, here to talk to us about WorldWide International Equity Fund. Please note that if there is enough time at the end, it will be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Eric, the floor is yours.
Thank you very much, Mathieu. And just before I get going, I just want to make sure that you can hear me okay.
Yeah, I can hear you.
Excellent. So we're really excited and really happy to be able to talk about the WorldWide International Equity strategy today. We are, in fact, celebrating today, this year, the 10-year anniversary of our relationship with SSQ. So this fund was launched with WorldWide 10 years ago in the middle of the great financial crisis, as we all recall, in 2008, and we just crossed the 10-year anniversary now. So the fund at the beginning was about 20 million, and today it's about 150 million. So we want to thank everyone for that. And this is really an important relationship for us. For some of you, WorldWide might be a new name, and that is because about a year and a half ago, we changed our name from Carnegie to WorldWide. So if you missed that, or if you're asking why is it called WorldWide and where's Carnegie, it's actually the exact same firm. It's the exact same people running the money, and nothing has changed other than the branding of the firm. So it's the exact same thing as what you would be familiar or known in the past. So Matthew, if you could go to slide number 2, a little bit about WorldWide, who we are, where we come from. So we were established in 1986. So we are entering, almost 32 years of history now. We are based in Copenhagen, in Denmark. The firm has about 100 employees. And I think most importantly is that the global equity team is made up of 22 investment professionals. And that's actually an increase of 2 people versus the beginning of the year. One point to note is that there were no departure in the last 5 years of this product, this strategy, the people that are involved in the management of the strategy. And actually at the firm level, or since inception, only 2 portfolio managers have left in the 30 years of existence of the strategy and the firm. So a very stable team, as we will see down the road in the presentation. AUM now are about, for the firm, about 25 billion. And in Canada right now, we are managing for about 2 billion of assets, mostly institutional. And I think one key point is that this product is only offered through SSQ in the SEG version. So it's they own that product in Canada on the SEG platform segment. Moving on to the next slide, slide number 3. Really, our philosophy did not change in the last 30 years. So we are a high conviction portfolio manager, as you will see later down in the presentation. We manage a 30-name portfolio. Historically, we have hovered around 28 to 30, but never exceeded 30 names. So we are the opposite of an ETF. We are the opposite of an index fund. We are really high conviction, and where we have conviction, we're not afraid to go and to have like a position in these names. As I said, we are benchmark agnostic, and really when we talk about the characteristic of the portfolio, you'll see that about 90% of the portfolio is actually different than the index or an ETF. And I think we think that this is important when you pay for active management fees. So when you pay fees, you want to make sure that your money manager or that your investment advisor are really going in and being active out there. And that's what we've been doing over the last 30 years. It's not something new. It's not something we went to. It's really been at the philosophy of the firm since its inception in 1986, as I mentioned. We are growth at reasonable price manager. We don't mind paying a little bit more for a name when we believe in the growth prospect. So we're not the typical value or the value manager that you can find that's for someone else. We are growth managers and really looking for those companies that steadily grow their earnings over time. We are long-term thinkers. Our average holding period is anywhere between 4 to 5 years. So our turnover is somewhere around 20 to 25%. That's been very consistent over the 30 years of the firm, and definitely over the last 10 years that we've been running that portfolio for SSQ. As you will see down the road in the presentation, when I talk about the investment process, we have a thematic approach, which means we're trying to identify themes or long trends that should support the growth of a name, the growth of a stock, and their earning. And I'll get to that in a few minutes, and I'll lay out what we think are the most important themes right now in the portfolio, but also in general in the market. Quickly, slide number 4. The point here, if you look at the pie chart on the left, is 72%. What it shows is that 72% of the AUM of WorldWide is global equities and international equities. So really, it's the bread and butter of the firm. This is where we spend most of our time. This is where we spend most of our research and energy and really fundamental analysis. And I think that's important in the sense that there are many firms out there, especially in Canada, that do many things to many clients, fixed income products or cash management or different type of assets class management. We just do one thing, which is trying to find the best 30 names in the world from an equity global perspective. And that represents 72% of the 25 billions that we are managing. Next slide. Really, this is the team. This is the team responsible for the management of the SSQ international equity product. 22 people. I think there are, for me, 3 things that are important in that slide. The first one, if you would do the average years of experience of the team, you would come up with an average of 24 years. 24 years on a team of 22 people, that must be probably in the highest you can find actually in the world in terms of firms managing global equity mandate. It's a very experienced team. It's a very broad team with a lot of expertise and in terms of experience. And I think even more important is that team's been working together for about an average 15 years. So they went to 1 or 2 or even 3 market cycles. They've lived the goods, but they've also seen the bad in the market, and they've been doing it together for 15 years. If you look closer to the top 4 people, Bo Knudsen, Bengt Seeger, Lars Winston, and Matthias Kolm, those are the decision makers in the portfolio. So the people below the dotted line or the research group or the support group, but really the 4 key people making the decision at the end of the day are the first or the top 4 in the slide. And I'll just, bring your attention to the number 2 guy, Bengt Seeger. He's been in the firm for 29 years. He's actually been running this product since inception, almost 30 years now. So a lot of the time, there are firms with 30-year track record or 20 or whatever, but you got to be mindful, or you got to ask yourself, like, who's been running that fund, even though the strategy has been out there for a very long time. Well, this team has been running the fund for 29 years with Ben, and you see that Bo and Lars and Matthias joined almost 20 and even more 20 years ago in the management. So it's a very experienced, they've been working together for a very long time, and they've been involved, one of them been involved since really the inception 29 years ago of the firm and the strategy. And we think that's, like an important thing to look at when you pick a strategy. Moving on to slide number 6, very quickly, some key points in terms of performance. It is a 4 stars Morningstar rated fund. We're really proud of that. That is really tough to do in a sec fund environment. So 4 stars for us is something like we're really happy. It's a fund that was a first quartile performer 6 times out of the last 10 years. The strategy has been offered. So 60% of the time it was in first quartile rank. And you look at any longer term period returns, it hovers around 1.7, 1.8, 2.4 annual added value versus the index over different market cycles. That's what we do. We have that you evaluate us on a full market cycle, so typically 4 or 5 years. And really that's what we're trying to achieve in terms of added value, 2.5, 300 basis point of added value over a full market cycle. And over the last, since our partnership with SSQ in 10 years, we were able to achieve that. Most importantly is that we try to keep the overall risk of the portfolio as defined by standard deviation somehow in line with a benchmark. And you look in the 10-year basis, it's a little bit below the benchmark. You look at 7 years, it's fairly in line, and 5 years a little bit higher. But in average over a market cycle, it should hover around the benchmark. And I'll talk about how we construct the portfolio to achieve that in a few minutes. Next slide, it's really slide number 7. It really looks at risk return, but layering down the entire universe of EFI managers in Canada. So we have a database called eVestment, which kind of tracks the performance on the institutional space, and really plot in a graph, any international equity managers that are available in Canada. And what you can see on a 10-year basis since our partnership with SSQ is that from a performance perspective, we were first quartile and a little bit lower risk than the median. So I guess that's where you want to be, like kind of the first left quadrant, and that's just like a graph and an illustration of the competitive landscape on the institutional marketplace. Moving on to slide number 8, I think this is probably the most important slide of the presentation, and it kind of summarizes what we try to do and how we do it. So what you have on the left is a circle with all of the names in the portfolio. You probably would recognize, I'm going to say 2/3 of 70% of the portfolio. We call it our circle of trust, if you want. This is, an illustration of the entire portfolio, and a lot of names you'll recognize. And if there's one way to characterize the portfolio, if you would Google any of these names, it would typically start with leader in the industry or number one leader in the world on what they do and things like that. So that's what we're looking for. We invest in mega cap names. We'll talk about some of the statistics, but I can tell you that more than on average, the market cap of the portfolio is actually twice the MSCI EFI. So in terms of average market cap, so the market cap is around $100 billion US, so about 135 billion Canadian, and the index is about 65 billion. So it's really mega cap names. Companies have been there for a very long time with very stable track record of growing their earnings. Maximum 30 names, I said a little bit earlier, we have conviction in our portfolio. So we typically are over around 28, 30 names maximum. And what's unique about our process is to be able to add a name into the portfolio, we need to take one name out. So that's a discipline that we've been applying since inception. So it's not something we just incorporated a few years ago, built these new best idea portfolio, but something we've been doing for the last 30 years. So what it means is that it's typically easy to come up with new ideas or new things that you want to have in the portfolio, but you got to be able, that name has to be stronger than the weakest link in the portfolio. So it's got to be an investment case where it's better than what we feel is the weakest link, and that brings in the portfolio, and that brings a lot of discipline, and that also helps us keeping the turnover of the portfolio relatively low in the 20-25 percent range. Said a little bit earlier, our active share is above 90%, and that's been constant since inception. It'll hover anything between 92-93%, which means really when you invest with us, you can be assured that you have an actively managed strategy that is definitely different than the benchmark or any ETF that you can have access to in the marketplace. Moving on to slide number 9, we like to talk about Nestle. I was talking about some of the names, and I've been in the portfolio for a very long time, and our very disciplined and low turnover approach. Well, Nestle has been in the portfolio in the strategy for the last 30 years. And why is that? It's really because it really represents what we are looking for in a name. And what we're really looking for is company over time that can grow their cash flows and their earnings between 5 to 10% over time and over years. Because we believe that when a company can grow their earnings 5 to 10 over time, the price will reflect that over like a market cycle. And what you have in that graph, if you look at the orange bar or line, I should say, is really the price appreciation of Nestle over the last, I believe, 25 years since 1994, where the price was around $10, and today in 2018 it's about $75. And what you have in the line that is kind of the light gray is really their earnings over time, and you can see that over time, really the earnings and the price of the stock are moving together in tandem, and actually the correlation is quite high. So that's the kind of company we are looking for. Companies that grow their earnings, company that grows their cash flow. Why? Because over time the stock price will reflect that, and there's that correlation. And I said it a little bit earlier, we are top managers, so we are okay paying a little bit more for a stock in the short term to find these companies or to have these companies that will grow their earnings over time in the portfolio, because we know that if we are right and the companies deliver on their earnings and their cash flow, that eventually the stock price will reflect it. And I think Nestle is a great example of that. Moving on to slide number 10, very quickly, this is how we screen the universe. There are there's about like 4,000 stocks in the universe we can pick from, and we have different screens. I'm not going to get into the details of that because that could take an hour just in itself, and we got 30 minutes here. But really, we have strategic screen and different way to screen the universe to bring down the universe from about 4,000 names to about 700 names. And really, what we do in these screens is that we're looking for companies that are into a non-regulated oligopoly. Why is that? That's because typically these companies have a lot of pricing power, and their ability to raise prices over time really is what allows them to grow their earnings, right? So we're looking for long cycle industry and really companies that focus on shareholders. So very rapidly we can screen the universe from 4,000 to about 700, and this is where after the real work starts for us, and where we do all our fundamental analysis and we really deep on every name to understand what's going on in these. Do they have sustainability, competitive advantage? What's their governance? How do they incorporate some of the ethical and environmental issues in their process? And you can see that valuation is the fourth element, and that ties back to what I said a little bit earlier. We prefer a good company, a well-managed company with reasonable earning growth potential, and pay a little bit more for it than a cheap company. So we're not the value manager. We're not, that's not our market. We're looking for a company that can grow, as I said, steadily their business and ready to pay the price for it, and be patient and wait for those earnings to be reflected into the price of the stock. And that's how we get to the 30 name portfolio. Moving on to slide 11, we call it kind of the triangle. And you can see that at the bottom, it's what we call stable growth. And you'll see Nestle, you'll see companies like Unilever. So what we do when we bring all these names together is that we want to make sure that the base of the portfolio is actually a little bit less risky than the benchmark or the universe. And what that allows us is that it allows to take a little bit more risk in our thematic views. And as an example, I just lay it down there, HDFC, which is an Indian bank that's been doing extremely well for us in the portfolio for the last 15 years, and another name, TSMC, which is a chip producer, and their chip goes into iPhones and different smartphones or different computers. So the fact that we build a portfolio with a very stable growth basis with companies that typically have lower earning volatility, lower cash flow volatility, and price volatility as a result, allows to take a little bit more risk in some of the names or in our thematic. And I'll get a little bit later down the road in the presentation of what are our more predominant teams right now in the portfolio. It's really the combination of the two that allow us to shoot for about 300 basis point of added value with a risk in the market, which is aligned, because we have a very stable base with those stable growth names, and then that allows to take a little bit more risk on our thematic views. Moving on to the next slide, slide 12. It's kind of showing the portfolio from a regional and sector perspective. And I think the thing to remember from that slide is that even though we have a high conviction portfolio of 30 names, you can see that the portfolio is really well balanced and really well diversified from a sector allocation perspective, as well as from a regional perspective. So we try, even though it's a benchmark agnostic approach, as I said, risk management is an important piece of the strategy and our philosophy. So we try to balance, the sector allocation as well as where we get exposure from a regional perspective. So that's what we try to highlight into that slide. Because we are kind of tight from a time perspective, if we could go into slide 14, please. What we highlight there is kind of, some of the portfolio characteristic on page 14. And really, it shows that on page 14, please, it really shows some of the characteristics from a valuation growth, and quality of assets. So what you will see is that, as I said a bit earlier, we are fine paying a little bit more for good companies, and you'll see that our valuation ratio is slightly above of the benchmark on price to book, price to sell, or even price earning perspective. But you will see at the same time that the expected 3 to 5 year growth perspective is about 25% higher than market. So the growth potential is there, and that comes with the higher valuation. But it doesn't mean that we are not looking for companies with strong balance sheet and quality of asset. And if you look at the ratio from a quality of asset perspective, you'll see that the fund, in terms of return of equity, return on assets, operating margins, or debt, is better or equal to the benchmark. So we are looking for growth, ready to pay for a little bit more, but we're not going to sacrifice on the quality of the business and the quality of the assets. And I think page 14 is kind of trying to illustrate with numbers, it's kind of the proof of that. Page 15, we think that in the context of Canada, if you're going to pick an international equity manager to diversify your portfolio, that it's important that you pick a manager that has a low correlation with the Canadian equity market. And what we're trying to show here is really on a 5, 10, or 20-year basis, the correlation of the strategy, the WorldWide strategy with the TSX versus other international equity managers in Canada and that are offered in Canada. And you can see that from a quartile perspective, we are on the first quartile, which means in this case that we are the lowest or amongst the lowest correlated funds versus the TSX index. So, if there's one thing we've all learned from the financial crisis is that when something happens, you want to make sure that you enjoy some diversification benefits. And clearly, by having a low correlation with Canadian market, we think and we are a great diversifier from a Canadian equity perspective. I said a little bit earlier, if we could go on page 18, that we are a thematic manager, which means that we are looking for trends and themes, longer trends in the world to support the earnings or the cash flow of the company. On page 18, this is how we split the world and how we're looking for themes. So we have major themes or trends like demographic, global consumer, technology, resources, and politics. And then from these master or main ones, we derive many others, and the total is about 45. So it's really, this is how we work, but obviously that's too much to go through in a presentation. So if I could bring you to page 19, this is kind of the summary of our biggest or most important themes right now in the portfolio. So the first one is the rise of the nation state. Really started with the election of Donald Trump, and essentially what it means is that more and more frontiers are less open. There are more tariffs. There will be more trade war and things like that, and we think that will continue and actually increase. And at the same time, you see that globalization is actually going down. So that has impacted for the portfolio, and we position the portfolio to take benefit from this. The third most important theme in the portfolio is everything that has to do with cloud computing and artificial intelligence. We think that is probably the sector or the theme that increases the most rapidly, and the position has been positioned to benefit from that as well. The last one I will mention is really the growth of the middle class. In Asia, when you combine, especially China and India, there's about 150 million new people headed to the middle class every year, and the portfolio has been positioned again to take that into into consideration. So I mentioned HDFC at the beginning. Well, they are the largest mortgage provider in India. So that's one example. From a cloud computing perspective in IA, I mentioned TSMC at the beginning. Well, they are the largest foundry, which is companies producing chips in the world, and position to take, profit of that. In summary, if we could go into slide 24, we think some of the reason why you should look at us is really we think we're bringing a very experienced and dedicated and very stable team since 1986. We've been doing the same thing, the same way for the last 30 years, and the same 30-name approach where to bring one name, you got to bring one name out. And we think we have a proven way of, managing that, should continue over a normal market cycle to perform. So it's not easy to summarize such a depth process, and there's so much to say in 30 minutes, but I hope that I was able to summarize it and at least pick the interest in the strategy. And more than open to take questions or comment at this point of time. So Mathieu, I'll just turn it on to you now.
Okay, so thank you, Eric. So like Eric mentioned, we'll now proceed to the Q&A part of the webinar. So as of now, there's only one question. If you do have any questions, please use the Q&A section of the WebEx interface to ask your question. So your first question, how do you manage the risk with only 30 stocks in the portfolio?
Well, that's a really good question, and we get this question quite a lot from institutional consultants. So as I mentioned a little bit earlier, we have 30 names, and to bring one name in, you got to take one name out. So most of the analysis before adding a new name in the portfolio is really to understand the risk characteristics of that name and making sure that by bringing a new name, we do not change the overall risk profile of the portfolio. Our objective is really to have a risk which is in line with the portfolio. So we're not the less risky portfolio manager you can find. We have a downside capture ratio, which means when the market goes down, by how much we go down, it's about 100%. So typically, we go down about the same as the market when the market turns out a little bit less, I should say. But we're not building the portfolio to be less risky. We're building a portfolio to have a risk aligned to the benchmark. And really, every time we make a portfolio change, we spend a lot of time, and most of the time goes into making sure we don't change our risk profile from a diversification, sector allocation, or country allocation, that we're not taking more risk than the benchmark, and that the overall portfolio remains the same. The other thing I would say is that with a 30-name portfolio, we know really well the names that we have in the portfolio. If you recall, we're about 22 investment professionals. So really what it means is that, every investment professional needs to know in depth 2 names or less than 2 names in the stocks we own. So we know these companies really well. We've been following them, most of them for more than 10, 15 years. So we have a good understanding of the name of the portfolio versus other managers that run 100+ portfolios. So that's how we manage the risk, even though it's a 30-name portfolio. We know these names really well, and also that's at the core of what we do when we add and remove or change portfolio.
Okay, great. Well, thank you, Eric. So there are no more questions, so this will conclude the presentation. To all who have listened to the webinar, thank you for your participation, and come back in November as Budel Goodman will present to us their U.S. equity strategy. So thank you, everybody. Have a good day.
Thank you.